Welcome to Ilagan Whiteboard Friday, where we look at complex legal and compliance issues in a simple to do ways. This series is brought to you by Ilagan, your partner and provider of end-to-end business services.
Hello and welcome to Ilagan Whiteboard Friday, where we look at various tax and compliance related issues in a user-friendly fashion. Today we will look at what is transfer pricing. Transfer pricing is generally applicable when you are doing business with a related party. See what happens if you have opened a company and if you are doing business with a normal customer, your pricing decisions are governed by the main motives of the business. For example, whatever your costs are, you add a markup of profit there and then do business with the customers. But what happens if you are doing business with your own company or if somebody very related? In those scenarios, your pricing decisions of any product or service or any other trade could be impacted by what is by your relationship with that company. So overall the profits of the business can go down. You can just be also make a loss making company or even a company with lowest profits and stuff, so that the taxes can be avoided. So in order to prevent this, globally there is a phenomena called transfer pricing, which comes into picture whenever you are doing business with any of the related party transaction. Now what is a related party? A related party is something where either you own or control a majority stake, or if any of your relatives is involved into a particular deal, or even your pricing decisions with a very large customer who can actually impact your pricing decisions. So those are some examples of being a related party. In those scenarios, the government has given transfer pricing norms. So you have to follow those norms. It's called generally an arm's length pricing, where you have to follow those norms to arrive at what profit levels you should charge, so that it is also acceptable to the government. So that is called transfer pricing. So transfer pricing, this is very common scenario in things like, for example, you have a company in US, UK or anywhere else in the world, and you open a development center in India. So by providing all the infrastructure, everything in India, the Indian government may not get any taxes because you might be selling to the US company or billing to the US company at loss, or it can be just at cost. So you can never have actually lifelong profit into the company. So that's why transfer pricing helps the government. So what it means is you have to arrive at your various costs, and this cost would not just include the salary cost. It would be the complete set of costs, like including your administrative, marketing, sales or any other overheads that you have. And whatever cost you have to add a certain amount of markup. It could vary anywhere between 5% to 30-40% as well, depending on industry to industry. So what you have to do is you have to look at similar set of companies or similar setups which are in existence with similar kind of turnover or experience, and then derive at what pricing formulas they are following, how in a normal scenario in customers what it is. So based on so many complex things, you have to check a lot of databases to actually arrive at what would be the right markup that you should charge on your cost to arrive at a transfer pricing. So that's what is transfer pricing. This is applicable only for related party transaction. So if your company is doing business with related parties and other parties, so on the portion of the revenues that you generate with other parties, this is not applicable. Only on the amount of money that you are generating on the related party transaction, you have to calculate things like how much exact cost have you incurred for delivering that project. And so there are auditors, there are chartered accountants who would help you to estimate those costs, who would help you to see whether transfer pricing norms are fulfilled correctly or not. So that's when it is applicable only for related party transactions, not for normal course of business. What all things it covers? It covers not just the salary cost. I have already said it covers the entire gamut of charges or cost associated for delivering that particular, or to have that transaction, whatever cost it has taken, all direct, indirect, other overheads, all covers. So you have to add a markup to that and then arrive at a transfer pricing. Arriving at a transfer pricing is not a one-time formula kind of thing. The needs, the government norms keeps changing, so it is a good idea to keep evaluating on a regular interval. You could do it on an annual basis, you could do it on a half-year basis, so as to make sure whatever norms you are following is up to date and it is as per the industry norms. So arriving at TP, because if you keep deviating the norms, then there would be issues with the government. And there are a lot of compliances. For example, there is a different transfer pricing department where a proper detailed analysis of what your costs were, how much you have made money out of it, and how much taxes has been paid. All those calculations has to be certified, has to be done, certified, and then submitted with the government. Transfer pricing is not related only to international transaction. Transfer pricing as a concept is applicable to any related party transaction. It could be within India, it could be outside India. So any kind of transaction is covered under transfer pricing. So these are some of the things that you should be aware. Do let us know in case if you have more queries. We would be happy to support you. Send us an email at support@ilagan.com, or you can even check out our knowledge base at ilagan.com/kb. Thank you.